Hey, welcome everybody to this live stream here on 40 Finance channel. Talking about the Nasdaq stocks like always, and it has been a tough week, right? Earnings did not quite come in. I don't know. I mean, short of expectations, but on the same token, I don't know who was expecting a huge growth trajectory to come out of this earnings report. And I think you're starting to see that a little bit in the market because whereas we thought maybe with Google, Amazon going down so badly, that the Nasdaq would pivot towards a downturn, and we're just not seeing it. As a matter of fact, the Nasdaq today, if I can get my mouse over here, Nasdaq today is up plus 1.81%. Now that's the index as a whole. Dow Jones, that has been absolutely on fire, it goes up another 2%. And the Dow Jones has a lot of these characters in it, right? So it's an interesting time to be in the market, and anyone who tells you that they know exactly where this is going is probably wrong, right? Both to the upside and the downside. But today we're going to talk about the generals, the Nasdaq generals. Now that we have some more feedback on how things are going, and we're going to talk about, where do they go from here? And is it good news or bad news? Working through a cold, so you have to excuse my voice a little bit. I'll do the best I can. Let me pull up the QQQ holdings. Kevin Hawthorne, how you doing? Thanks for coming out. Okay, so obviously Apple was the big dog. So let's just start there. And as usual, I'm using my Seeking Alpha platform. My affiliate link is in the description. They're having a monster sale, $99 for a full year of Seeking Alpha, and that's an incredible deal. And I think, there's some platforms out there that charge $50 a month, $100 a month, which is insane. But if you're just looking for stock research and opinions, $99 for the whole year. Check it out in the description. All right, Apple actually up today, plus 7%. Okay, now yesterday's, let's get to that earnings news here real quick. So yesterday, it wasn't a huge beat, but you did beat by 2 cents. Revenue of $90 billion, beats by $1 billion. Shares initially went down, but you had products revenue up, you had iPhone revenue up, Mac revenue up in the era that all PC sales are going to suck, right? You actually saw an increase, and iPads were down. Service revenue, that's always surprising. I'm sure somebody will do a deep dive on that. Service revenue, you would expect to compound at a higher rate just as they get more people. We didn't see that. But overall, it's a pretty good quarter for Apple, which is obviously a huge component, particularly when you talk about the QQQ, when they're plus 10% of that whole thing, and that's likely to grow now. And if we look over to, let's see what we get in terms of ratings for Apple and how much that has changed. All right, so ratings. Actually, let me do this a little bit differently. Oh, not that. Earnings revisions. This is what we're looking for. All right, let's see how this trend has changed. And if we take this line, which is for the 1 year, okay? So how has the 1 year outlook for Apple changed now that we've let things settle, and this number will continue to move as more and more people update their earnings. They don't update, their earnings projections. They don't typically update, the very second stuff comes out. But you do see a small downtrend if you're going to look at it in terms of multiple years. And if we're over here, September of 2023, the table view is actually a lot better. You've got an EPS estimate for next year at 618. That's year-over-year growth of only 1%, and that's actually down in the past month by minus 4%, okay? And then on the revenue side, The updated projections for the next year, only 2%, and that's a trend that's down 2%. But the big call out here, I don't think it's a huge surprise that we are having a negative downtrend in EPS estimates and revenue estimates, but it's not a colossal failure, right, that so many people are projecting, particularly with FANG stocks, Nasdaq stocks, etc. So at least in Apple's case, the projection looks good. Now, flat, okay, if they really do only grow 1%, flat is not necessarily good, particularly if you're in a situation where the valuation multiple doesn't look like the valuation multiple is going to go up anytime in the near future because of the way, the bearish trend and the bearish sentiment that's out there. So Apple hanging in there and keeping the Nasdaq alive. What about Microsoft? We've had a few days now on Microsoft, so these trends should be easier to identify. Earnings, estimates. What do people think Microsoft's going to do fiscal quarter? Their fiscal quarter we'll find out about a little bit sooner in July because it runs a little bit differently. Basically flat, 3% growth from where they sit now. Where was the change? Oh, here we go. Earnings revisions. All right, so we talked about 954, basically flat, and the 1 month trend with all the new information that we've had out here, minus 6%. Okay, so I think that is the big difference in the way I see the news versus the worst bears. They're calling for the complete collapse, or they're calling for minus 20%, minus 30%. And with Microsoft, yes, the trend is down. There's still a projection for growth in there. It's small, but as far as like losing your investment entirely with Microsoft, it's just not going to happen. And I would say losing 30% from here, which would be another 60 some dollars, certainly seems unlikely, at least in my opinion. Revenue, plus 7%. That trend in projection is heading down minus 4%. But again, still have a little bit of growth in a difficult time. So the top two companies right now, at least in the QQQ, they're sort of projected to hold, right? And we might take that in this particular environment. All right, next, let's just skip ahead to Meta, because they obviously had one of the worst earnings calls this week. Let's see how their revisions are doing. All right, so this is their current fiscal year. What about next year? Okay, current fiscal year, we know all the bad stuff that's going on in Meta, right? That's not a big surprise, all the money they're spending, etc. You still have, in terms of next fiscal year, $9.55. It would be a small growth of 5+%, and it's trending down, but it's not negative. So that's the question with these generals is which way do you think it's going to go? You're down 34% in your, negative 34% on the EPS side. So that's where you're getting a ton of this valuation changing. But next year, does it stabilize or go up slightly, which would imply that perhaps it's a good time to buy Meta if you believe in the company. Going down to revenue. Still got some growth built in, and as a matter of fact, that 1 month trend minus 4%, but still saying positive, plus 7% potential growth. That's not where Meta is typically at, right? We're used to double-digit gains on both top and bottom line, but it's not a house of horrors, I guess is what I'm getting at. Let's look at, who's next? Amazon. Amazon, very rough quarter, particularly with some of the stuff that we saw on the consumer side, and that doesn't project to be going better here in the near future. Let's see how their revisions are going. It's definitely negative. You can see this graph, but let's skip this year, which is, they're probably going to end negative, right? And I think that that's been projected for a while because the costs are just way outside of the expectations. And that's what's been disappointing about Amazon. And I myself projected that Amazon would get a handle on those costs heading into the back half of this year. We still haven't really seen it. So that's concerning, but it's also hard to control some of these things when the Fed's doing what they're doing. But I would say I'm disappointed in their effort to this point in getting some of these costs under control. If you do look at next year, though, they've disappointed this year, so they have to earn our confidence. But if you look at next year, you're talking about a 226 potential EPS, which, that's a forward PE of, 50 something. So it's probably still expensive, but at least they're coming back, into the right mindset. Now, revenue-wise, remember, we've got a lot of consumer input here. We have a lot of cloud input. Revenue growth for this year could still hit 9%. And then next year, while the trend is down in projections, 15% year-over-year growth is not terrible. It's not terrible when you think about what CNBC and the television's trying to say, right? Which is just a flaming pile. And I don't know if we're going to see that. Maybe we will, but it's not as bad as the sentiment suggests, in my opinion. Now, those are some of the big generals. We got Google in there too. Let's just hit Google real quick. How has their earnings estimate changed? This year, minus 13%. Next year on Google, I'm missing the revisions tab. Okay, same thing I just said, but let's just look ahead to next year, 556. Don't forget, guys, if you're if you're watching an individual stock and where we are here today in October, heading right into November next week, 2022, 2022 is done in the eyes of Wall Street. I think most of us, maybe with Apple, who actually kicks off their first quarter now, but, holiday shopping is projected. You're going to get some fluctuation, will probably be negative on holiday sales, although you can't guarantee that for e-commerce sales because e-commerce is, of course, such a growing segment still, even in the United States. But 2022 is done, okay? Everybody's wondering 2023 from a projection standpoint. And the hard part, if you're a cloud provider, is you have to rely on corporations going into the cloud. How much money will they spend on that? Speculation at this point is that corporations are going to hold their money tight, right? They're not going to take on any new projects and expenses when the economy is in this way. And that makes sense, but that is factored in to our projections that we have here today. So if we're on Google here, and we're looking at 2023, from an EPS standpoint, you still have projections for double-digit growth, at least for Google. I think that's the best we've seen so far. And then on the revenue line, yes, the trend line is down, but it's still plus 10%. Chestad, good to see you. Meta is almost at the price that I sold Facebook for in 20. The Meta decline, I've heard that stat that you talked about. I think they're at 2016 levels. Unbelievable. Unbelievable. But, it just depends on what your thesis is on that company. I will say with the advertisers on this list, so if you think, I think Amazon's advertising, which of course is marketplace advertising, a lot different. Ford, cars, big, brand advertisers are probably not coming on Amazon Marketplace. But if we talk about Google, we talk about Facebook, then obviously brand spend with advertising and the Apple changes have been a huge headwind, much more than I would have projected. I think, if we go back to January of this year, I think we could foresee some of the Apple changes. We knew that was going to bite into profits a little bit, but then you got into this economy nightmare that the Fed has put on us, and it's affected brand spending. And so you get that double-edged sword. That world will change eventually, and you would hope that as inflation comes down, that the need to compete in the broader economic marketplace, the need to compete if you're selling things is going to go up. Competition is going to go up. I'm trying to think of an example. Let's just say you're selling lawnmowers, okay, just to pick something, or cars. Now that we get back to a normalized economy, how long will that take? I'm not sure. But when we do return there, the competition to sell your lawnmower is going to increase. That is going to increase advertising budgets. It's also going to bring prices down. And the competition in the marketplace will eventually lead people back to Facebooks and Googles because they're going to have to generate sales. They're going to have to generate awareness. It's just the way it is. Right now, we're in weird times, and we see what's going on. The Apple privacy changes, I have a whole thought process there, but I will say that I feel pretty good without any actual evidence. I feel pretty good that Facebook and Google are going to figure that out. Somehow, some way, I don't know how exactly. I'm not an engineer, but that can't go on forever. Okay, because that continues to eat into ad performance, and eventually consumers and advertisers are going to have enough of it. All right, I don't know when that day is, but it can't go on forever. And Apple, I think, is playing with fire there. The way they continue to lock down and the way they continue to demand 30% from their app store, I think they're playing with fire. Right now, that situation is working, so kudos to them. But the more you wall things off, you actually start to build up a significant risk case for yourself if the world were to turn against you, right? Or bad news turned against you, being walled off doesn't always help you in that situation. But that's a topic for another day. How about chip stocks? So chips are so interesting right now, and the sentiment is so bad, right? And chip stocks make up a huge part of Nasdaq, and there's not a lot of reason to be happy about chips right now, except for one thing. When you looked at the Apple numbers I showed you earlier in this video, Mac sales were up slightly year over year. Meanwhile, the whole world is talking about computer and PC sales being duds. But you also have servers, and you also have Internet of Things. I'm not saying those areas are rosy, but what I will say is that I personally believe AMD, NVIDIA's, take your pick, are going to sell more chips tomorrow than they sold today. Now, that tomorrow may not be the first part of 2023, but when you're thinking about a long-term investment, I think the value proposition is still there for these guys. Let's see how their revisions look. I haven't looked at these individually. I do not own an individual chip stock. Perfectly happy with what's in the queues for that. But we go down here, and here's the drop. All right, so if AMD hits 366 this year, it'll be plus 31% on the EPS line, which is great. Don't forget that I don't think AMD was profitable prior to COVID. Don't mark my words on it. Now, next year, that growth, as of today, is projected to slow to 8.25% at 396. Which way, we're in a very bearish time, right? I mean, I would say bearish sentiment on chip stocks is, I'm not going to say it's the all-time high, but it's not good. So I would be more inclined to say this could beat to 4% just because we're at the low of bearishness. Take that from a guy who has plenty of bags that he's holding, right? But with the way chips are in so many things, I can see how that turns. Now, revenue, you still got double digit. It's obviously not COVID time, and the trend is coming down significantly, but you're still double digits. So NVIDIA, or excuse me, AMD as a flyer, as a standalone chip, if you're looking for it, I don't think it looks that bad from a growth perspective, right? But, everybody's got to make their own call. Now, NVIDIA, who I think is a little bit different than AMD, just in the graphic processors, I don't know if I'm as bullish, but let's face it, NVIDIA has outperformed. Just when we think demand for their stuff couldn't get any higher, it does. But you can see how these estimates are lagging a little bit. Well, that's not the estimates. Revisions. And this is crazy, actually. You can see how this trend is settled. So Jan 2023, the 6-month trend. So 6 months ago, this EPS estimate was 40% higher than it is today. And look how that is slowing, okay? It's really slowing. So you have to wonder if with these generals getting beaten up, is this coming to an end on the low ball projections? Can't say for sure, but I do say that NVIDIA, they have another wacky fiscal calendar. Basically on February 1st, give or take, they're going to be starting fiscal year 2024. And their EPS growth right now projected plus 32%. And on the revenue side, again, this looks terrible, flat, but this 2024, it sounds like a long way away, still projected to be double digits, all right? And the trend of that coming down, 6 months ago, minus 23%. 3 months ago, minus 19, and here we go. Not a lot of movement over the past 30 days. So as far as these generals go in the Nasdaq, the good news is, and that's the saying that I sort of made on this, that I titled this video, the generals have been taken out, right? So some people look at that when the big dogs of the market have been either taken out or survived, in the case of Apple, and I'd throw Microsoft in there too. Does that the all clear? It just depends on what your mindset is. If your mindset says, a popular opinion right now is that the effects of what the Fed is doing won't be felt until into next year, which, I can see that. I really can. But if you're buying for the long term, and we say the effects will be felt, let's say by March or April, then next year goes all the way to December, right? Where is it for a year from now? And that's mostly what we're looking at on this channel. Where are you a year from now on AMD? Let's just assume there's more pain to be had and 10% to be lopped off along the way. Do you start the position now that the generals have been hit? Or are you saying fourth quarter is even worse? So I'm going to wait till Jan, Feb, and I'm going to buy there because the fourth quarter is the bottom of the bottom. I think DCA starting now seems to make a little bit more sense, but everybody has their own way. All right, let's take a quick look at the news. And this is just a recap of what's going on today. So after the bad news, and funny enough, I see Intel, if that shows up on the screen, plus 8%. This is the kind of stuff that gets celebrated. I'm going to switch over here. Right here. This is what you're going to start seeing, and I just made a video about some of these things. These are the kind of headlines that can bounce a stock significantly. Job cut plans met with Wall Street's approval. And you're going to see more of these headlines. So even a dog like Intel, that their master plan is still 2 years away, and they haven't made a lot of progress from a stock perspective, But now you start to see what people are looking for. It's the cold winter. It's the Bezos batten down the hatches. We want to see people cutting jobs. We want to see budgets getting cut. We want you to reassure us, Google, Adobe, AMD, we want you to reassure us that you are making provisions for the worst case scenario. So Intel's growth, as they're up 8%, I mean, they're a nothing burger on growth going forward, at least that I'm aware of. Let's take a look here. Yeah, EPS, okay, down 57%. Next year, down again. Revenue, minus 13%, flat if things go well next year. But plus 8%, because that's the kind of stuff Wall Street's looking for. They know you can't recreate the top line and the bottom line in this scenario. It's just too hard. But what you can do is cut expenses, and so that's the expectation. So if Facebook comes out, for example, and identify, everybody's on them for the metaverse and the billions of dollars they're spending. You don't have to cut that necessarily if you believe in it, right? If that's a core thesis for their growth, they don't have to cut that. But what they can do is start issuing headlines like this, one we just saw on Intel, and saying, you know what, remember that, I'm going to make this up here, remember that scooter project and whatever that came in? We're cutting that. And we're also cutting 10% of our marketing department. This is what you're going to see. You're going to see Facebook, Meta, start to benefit from that. And every company known to man is going to start doing this because it's a free win. It's an absolute free win. And let's be honest, one of the things that came in on Google, I don't know how much you guys studied it, but their headcount went up this quarter. Big no-no in this time. And I'm sure if we think back to what this quarter is, right, which is we're in October right now. So this quarter started in, let me do my math, September, August, July. So this quarter started in July 1st, different time. The Fed wasn't quite as aggressive, and somehow they added another 10,000 people or something. And as soon as Wall Street sees that, they're like, oh, well, you're not even trying to cut. We want to see documented proof of cuts. And Intel's playing the game very well, and hopefully the stocks you own will do that as well. Cold stock boy, horrible year for tech sector. You are absolutely correct. But what, let's skip the first, I'm going to say this about tech sector, QQQ, etc. One thing's for sure is the demise of it that I got excited about that came in spring, I certainly could have benefited from waiting a little bit before I jumped in, but this is where I'm at. It's not a big deal. I'm in for the long term. I think Q's for the long term. As you guys know all this already, I'm a big fan. But let's take off January through June, just for fun. And let's see if I can do that. All right, so let's go year to date. It's a simple year to date chart. And what did I say? June. So June, actually, of course, we had a bump here in June. But let's just say you got in at 313, which is roughly June 1st, versus 389. There's also somewhere in here, I keep hovering over the wrong thing. There's a 400 in here. But let's say you woke up on June 1st and you said, back half of the year, that's what I'm going to do. You're at 313. You're still down, 313 to 278. But you have to start thinking that 313, and assuming you didn't average down at all, that it's a good time. Well, I don't know if good time to buy, but how about this? There's less risk in buying today. That I will definitely stand on that cross. There's much less risk of buying today than there was back in January. And if you're talking about 2 to 3 years, then I think it's an easy win for all the reasons we just covered. Now, the problem for a bag holder like myself and a knife catcher is that I was way too excited over here. And it wasn't at 400, it was this one. You know, end of January, huge drop, roughly, what would that be? Roughly 20% from 400. And here's me, you know, I'm in here somewhere. And then, you know, maybe starting to second guess, but buying a couple shares, and then this, right? So my mindset changed at 370, like, hey, this is good. We're in a good situation, but blah, you know, and then blah even more. We got ourselves a little bit of a rebound in August, and now blah again. And, you know, depending on what historian you talk to, they're going to say this keeps going, right? Just like this. Down, 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 up, up, up a little, down even further. I don't get into charts that way. I don't get into graphs helping me analyze the fundamental values, but they could certainly be right. I'm on the other side of the coin, though. But yeah, nobody's going to say 2022 was the year for tech. And to me, I guess I'm really not that surprised. I'm surprised that I wasn't more realistic with myself, but I'm not surprised knowing what we know about the valuations. Now, the thing that is going to be super interesting is going to be the middle of the pack. So I'm trying to think of the best way to get. So when you think about cloud, and you think about some of these oddball companies that haven't even been touched, CrowdStrike, okay, 1 year is minus 41%. However, from, that's 1 year. Let's do year to date. Okay, 18% on the year to date. This thing, look at this forward PE, 123. So when I say hasn't been touched, yes, it's down minus 18%. Yes, on a year it's minus 40. But we're still sitting here. That's an interesting stock, to say the least. Now, I'm not buying it at 100 times forward PE, but it is part of Nasdaq, so I've got my little slice in there, somewhere. It's not that dissimilar. I think Cloudflare. Yeah, Cloudflare. Okay, well, never mind. Minus 70% on the 1 year. Year to date, minus 57. But look at this realistically. 3 cents forward EPS. So that puts you at whatever that is, 1,700 forward PE. I don't know what you got there. I wouldn't feel super duper good about it. I'll say that. I'm trying to think of other NASDAQ stocks. Enphase, there's one that, I made some mistakes in Enphase, including owning it and selling it when it started to tank. But here we are again in an area where I wouldn't feel super good about a forward PE. I wouldn't feel super good about these earnings. 437 on the forward, not that they can't do it, but you got to wonder how many housing projects are about to stall. You got to wonder how many people who took out mortgages to do solar installs, that world's drying up too. So I don't know. I don't feel particularly good about it. But Enphase untouched in this environment. Year to date, plus 64%. 1 year, plus 40%. There's some names out there that for whatever reason, people are going towards, and it's that middle pack of the NASDAQ where you can find some of these things. What has, let's see, Snowflake. I haven't looked at some of these, by the way, in a long time. Snowflake, okay, I think this is the Warren Buffett one. Okay, EPS is 17 cents, forward PE of 900. Jeez, I don't know. Where does that go from here in this environment? It's hard to say. And what people are hoping for, which I give them credit for, is this. Forward growth on the revenue side, plus 73%. I'm guessing their EPS, because it's so small, is not projected, but yeah. And then on the flip side, you have Paulie down there, who's talking about energy, which, yeah, what a unbelievable year for energy. And that's another one that if you're, I'm just looking for the spider for the energy sector. Obviously, you got green. Why can't I get to that one? Obviously, you have green and traditional. I think the case for traditional is certainly getting up there, right? We're starting to see that more and more. The only one I really know here is Exxon. Let's see what they did. I want to find the sector spider for it, but I can't think of what it is. Year to date, plus 73. 1 year, plus 71. EPS 4 to 13. So the game here, and obviously this PE ratio is awesome, but it's all based on the oil prices. That's not to say it won't go up, but if you look at it, let's see if we can do this. Valuation. All right, PE non-GAAP forward, 8.25, 5-year average. So it's well under the 5-year average. That's what I was really looking for. And what about revenue? Price to, I know they don't go price to sales, but I was just curious. So they're right in line with their 5-year average on price to sales. So I was looking at that in terms of revenue. We don't have a 5-year average on the gap for some reason. But I think that this year definitely proved, and with what we're seeing from some of the international relations, that there's still game for oil stocks. Is this the time to get in? I don't know. But I've been thinking about that. I bought into some of the philosophy that oil use cases for oil in general will generally decline over time, right? But I think what is overlooked here is just how long that's going to take. And the other thing that's overlooked is even if the use case goes down, let's just say 2% every year. I'm just going to make that up. If the price per barrel sticks at where it is today, then the profit lines are still going to go up. So I don't normally look at oil stocks. I don't normally buy, I'm not targeting dividend stocks in general. But, until we get, I would say, a different president who's going to open oil exploration again, then I would imagine this price is not changing. And this is all coming from a guy who's not an oil expert, by the way. But what happens if we get a different president who opens it up? I don't know where the price goes from there. But certainly in the short term, it doesn't appear that the price of oil is going to change a whole lot. And even if it did, even if we got down to that $70 a barrel, that could be the time to buy, depending on your outlook, because, how much lower could it possibly go? It's a tough one. There are lots of people who study the oil market for stocks, and I don't want to pretend that I'm that guy. So just learn more before you jump in. All right, any opinion on ATVI? 30% gain if I think the Microsoft deal is stuck in Europe, the last I read. Let's see if Seeking Alpha, it's UK. The issues that the UK antitrust laid out issues it will take up in its review, indicated that it will take a hard look at Microsoft assertions, in particular whether Microsoft could decide to make best-selling franchises, if they would pull it from PlayStation. Let's see if we can get a speculation date on when this would go through. It doesn't really have it, but that's what's holding things up. I think your assumption of the plus 30%, last I read, let me see where this is at. Plus 72. Has anything moved? Okay, so it's down. Deal approved. Let's see what this guy says, or girl. There's no legal reason. I estimate the deal. Okay, so this individual estimates the deal approval at 80%. This is might as well be me saying that. I don't know who this is. And they're going along with you, Paulie. 30% discount to buyout level. Let's see if we can get a chart somewhere on here. Yeah, there could be something. So this is Microsoft's offer. I don't see it. It looks like 95, and they don't go in that much detail. So you could be right. And what do they say? I continue to believe ATVI is a bet on common sense. However, this deal may easily close without their approval, as Microsoft will win legal battle, blah, blah, blah. Deal should then close in 2024. Okay. So if I didn't own any, which is me, and I trust whoever this person is to say that the deal closes in 24, I think you probably still have some time to screw around with it and see what happens. If it was a regular stock without this type of influence on the deal, you would have to say a lot of it is going to boil down to the video game industry and how they perform in holiday season. So if you already own some and you're like, should I buy more because it's a guaranteed 30%, I would say you'll find out, well, how about this? The big crossroads will come out in February when most of the Q4 sales numbers come in. So whatever they're selling, and they've got this new Call of Duty and all this stuff, it's all about the holiday numbers, and then you go into a quiet period for video games. So if you're adding, maybe do it slowly, because on February, I mean, I don't know how much farther this thing can go when they have a buyout offer around $95. But if it was going to go sour because of the industry, it'll go sour February-ish. And, you know, that's how I look at it. Yeah, and you're right. The problem is it tanks 30% if the deal goes up. I agree with that. Excuse me. All right, guys. Hope everybody's doing well. You know, Nasdaq, I'm still a fan. And QQQ, I'm still a fan. Nothing has changed. The generals are down. There's a lot of ways to look at it. It doesn't mean that mine is the right way. But what I would say is anytime everyone's saying one thing, right, make sure that you at least look at the other opinion. That's all you can do as an investor is read. And I think, you know, the lesson learned here is all the compelling cases that we heard about in 2020, early 2021. You know, everybody was talking about that. How are EV cars going to take over in 2 years? And now that the truth starts to come out, we realize that some of those assumptions are either dead wrong, or they're going to take longer than we thought. So when people are talking about sell everything and bear market and doom and gloom, just make sure that you're looking at the other side of the coin. Worst case scenario, read some bullish articles, even if you are a bear, and laugh at them if you want to. But you have to take into account both sides. And this is business, this is dollars, this is not emotion. You have to take into account both sides. So hope everybody has a great weekend. We'll see you on the next video.